Hello. Hello. Hello, I cannot hear you. Can you hear me? Hello.
Hello, yes, I hear you.
Okay. How are you?
I'm fine. How are you?
Alhamdulillah.
How is everything?
Alhamdulillah, everything is fine.
Yesterday we finished the class.
One second, one second, one second.
Yesterday,
Yes, sorry.
yesterday you finished the class.
Yesterday?
Yeah.
No, yesterday I had a class, but surprisingly, that student came and he said, I only speak Arabic.
That's very difficult.
Yes, I said that I don't know how to speak Arabic. Yeah, his English was very weak.
For me also, my English is very low.
Sorry.
For me also, the English is very low.
Yes, so he didn't understand English and I don't understand Arabic. So we just
Yeah.
took the class for 10 minutes and he was out of there.
Yeah. But for me also, the English also is very late, very slow.
Yes, but his English was weaker than you. He could not just say bye as well. He's saying khalas, khalas, khalas.
Finish.
Yes. So
Okay.
he was living in Mecca.
Maka, good, good.
Yes. So
He's from Saudi Arabia, I think.
yes, he didn't speak. He didn't told me that he do not know English. Actually, I
Good,
don't
good.
have time, so I cannot. I was thinking that I should work on it. That if my language converts live and uh, he could be taught, but I don't have enough time to just work on it.
Good, good. Okay.
Okay, so we were on F5. So you
Yes.
there were. Did you think again about anything F5, F6?
No, no, no. We are covered the new plan. Don't worry.
Okay, if you have any problem, I have no issue. Just you have to decide.
No, 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 no. It's okay now. It's okay. We are going through this way and to finish the F9 5 and then to come back to F9 F6.
Inshallah. Okay, we
If
were
you
on
don't have the issue.
inshallah. We were on throughput accounting ratio, right?
Yeah, we are through the account ratio. We are finished. Now we start the question number 1.
Mm,
61.
yes. We studied last the ratio of that accounting, no? Throughput accounting.
Yeah. Yeah.
So let's look at that ratio again, then we'll start going forward.
Yeah, I saw that one. Okay. You share your screen. Why today we don't have the screen?
I have not shared.
Didn't share the screen. Only that accountancy. Only online accounting.
Okay.
Yes.
Let me do one thing more. Yes. Now we were talking about the ratios. First, we just what is the total factory cost? We have to add the labor cost in the fixed production cost. We'll get the total factory cost. Then we talk about return per factory hour. Return
But
per
I have one question in total factor cost. Also, to include the material cost, right?
in what factory cost?
The total factor cost TFC to include the material cost. as to consider as the variable cost.
Yes, but we are considering here the labor cost as fixed.
All the labor cost as a fixed, but accept the material cost.
Yes, material cost is not fixed here.
Variable cost. Okay, that's good. Okay, can go.
Then we want to take out the throughput accounting ratio. Okay, throughput accounting ratio formula is return per factory hour divided by cost per factory hour. Okay, what is the return per factory hour formula? Return per factory hour formula is sales revenue minus material divided by time on key resource. Okay, time on key resource means the bottleneck resource.
Yeah.
And it is divided by cost per factory hour. How to calculate the cost per factory hour? It is calculated
Total factor cost. Total factor cost divided by time on key resources.
Key resource. If we have a TPA ratio, which is 1 minute.
Return on the factory divided by the cost of the factory hours.
One point is not written here. I want to just show you. If we are talking about the interpretation of the throughput accounting ratio, if the TPR, the throughput accounting ratio, is greater than 1, okay, it would suggest that the throughput exceeds the operating cost, so the product should make a profit.
Means that interpretation of the throughput accounting
ratio.
Okay, if throughput accounting throughput accounting greater than 1 means
the throughput, you can say the profit exceeds the operating cost, so the product should make a profit. Okay, so this is a good product.
Product make a
profit.
Okay.
Priority should be given to the products generating the best ratios. If it is more than 1, that is more good. And if the TPR is less than 1, it would suggest the throughput is insufficient to cover the operating costs, resulting in a loss. So you would not give priority to that product. Okay.
Means that throughput accountant is insufficient.
Yes. It means that you will not get profit from it.
Okay.
It will not cover your cost. Okay. If we come back to the formula.
Okay.
Okay. When we come back to formula, if you look at the formula, it is return per factory hour divided by cost per factory hour.
Yeah.
Okay. So if the TPA ratio is high, it means the return is high. You know, TPA ratio is directly proportional to return per factory hour. You know those concept of directly proportional and indirectly proportional?
No.
Okay. Directly proportional means when you are talking about this divide rule. Okay. If this value increases, this value will also increase. Okay.
Okay.
If this value decreases, this will increase.
Okay.
This is directly proportional. It will increase. If this will increase, it will increase. If this will decrease, I'm talking about general concept. Okay. When we have some formula like this, the TPA ratio equals to return per factory hour divided by cost per factory hour. It means that if this increases, this will increase. If this decreases, this will decrease. Okay.
Okay.
And here this is indirectly proportional. It means that if this increases, this will decrease.
Okay.
And
I got.
Okay. And vice versa. Okay. The first concept is this. Then now, keeping in mind this concept, you just again look at this formula. The TPA, if return per factory hour will increase, TPA ratio will increase.
Okay.
Return means
I
profit.
got.
Okay, return means profit. Then this product is good.
Okay.
Okay.
If the return per hour is the decreases, the TBA is come down.
Yes. And this is not good.
That's not good. Less than one means.
Yes, less than one. And if it is 4, 5, 6, you have 3 products.
That's good. That's good.
If you have 3 products, one is 4, one is TPA ratio is 4, one is 5, one is 6. So you will give priority to the 6th one, which is giving you the
the
TPA
big
ratio of
one
6.
is the greater one.
Yes,
Give
the
us the
greater
greater
one.
one, number one. Yeah.
Yes. Okay. So this concept is clear now. Okay.
Okay.
Now I think we should move towards, because these questions are not that much updated. We should look at the questions of the book. Okay. It could be just, we can just if we are going through it, we can just, what are the criticism on throughput accounting ratio? It concentrates on short term, because we are just looking at the bottleneck resource for the short term. So this is a problem of TPA ratio concept, throughput accounting concept. It is more difficult to apply throughput accounting concept to the longer term. Obviously, this focus on short term, so it is very much difficult to apply it to the longer term. Okay. In longer term, the ABC approach might be more appropriate. Okay. Then, now we are talking about the test your understanding. X Limited manufactures a product that requires 1.5 hours of machining. Okay. Machining time is a bottleneck resource. Itself, he has defined that machine time is a bottleneck resource. Okay. Due to the limited number of machines available, there are 10 machines available, and each machine can be used for up to 40 hours per week.
Good.
Okay. The product is sold for $85 per unit, and the direct material cost per unit is 42.50. Total factory costs are 8,000 each week. Okay.
Okay.
Then we have to calculate what the return per factory are. Okay. And the second, the throughput accounting ratio. Okay.
Return factor hour, return per factor hour equal to sales revenue minus the machine material purchase divided by the total product cost.
Time on key resource. Now, which formula you are reading? Sorry.
Time on the bottlenecks.
Bottlenecks. Yes. Yes.
Time on the resource key.
First,
I can check the sales. The sales is 85.
Selling price is 85
per unit.
Per unit.
Yeah.
And we are talking about the sales revenue. Yeah. So we need that how much products we are doing. Each machine can be used for 40 hours per week. Okay.
Yeah.
So how much sales revenue we'll be getting? So every product requires 1.5 hours of machining. Okay. So we will multiply this by the 1.5 hours.
Yeah.
Okay. I'm just going towards the answer so I can just explain you. Just you try first, then we'll just look at this. This will be good, more good.
Okay.
Okay, you try once, so we'll be going to answer.
Okay. The sol per hour, the cell unit per hour 25 multiplied by 1/5.
Sorry, repeat your point.
I said that sales equal.
Yes, sales revenue is equal to
8.5 into 1.5.
85 into 1.5. You are saying?
Yeah, 1.5.
No, like this, if we are talking about the total factory overhead, factory cost he has given for 8,000 each week. Okay. So we are talking about the 1 week. Okay. And how many the machine can be used for up to 40 hours per week. Okay.
10 machine.
There are 10 machines available, and each machine can be used for up to 40 hours per week. It means we have 40 multiplied 10, 400 hours available. Okay. And
What does mean?
40 hours we have per week, and we have 10 machines. So 40 multiplied 10,
400.
400 hours are available, and
Yeah.
400 and 1 unit takes 1.5 hours. It means 400 divided by 1.5.
Okay.
Okay. Then what does it comes? Divided by 1.5.
2666.
266. So 266 units are produced. Can be produced.
Okay.
Then 266 multiplied by 85. This is your sales revenue.
22,666.
Yes, 266 multiplied by 85.
226666.
So, okay, say okay. 226.
Yeah.
Okay.
Okay.
Return per factory hour we have to calculate. Sales revenue is we got the sales revenue. Now we want the
Yes.
material purchases. Okay. Direct material cost per unit is 42.50. So 42.50 is 1 unit cost of material. So we multiply by
2666.
yes. Then what we need, time on key resource. What is the time on key resource? What time it is taking per unit? It is. Please let me
Second
know.
hour. 4th hour.
No. What time it is taking on key resource? 40 hours is total.
1/5.
Yes, 1.5. Okay. So it will divide it. We will divide it by 1.5. Then we will come to cost per factory hour. Okay. When we will be calculating cost per factory hour, so we need total factory cost. What is the total factory cost? Fixed production cost, including labor. So there, here it is written.
No.
Total factory
No.
cost is 8,000.
8,000. Given.
Yes, given. So 8,000 we will be dividing by time on
But
key resource. That is
second
again 1.5.
1/5.
Okay. So return per factory hour. Now we'll just divide these both figures. So we'll get a ratio.
Yeah.
It is clear to you?
Yeah, clear.
Okay, now look at the answer because it could be wrong. Just provide the answer just down that page. It was 3, right?
Yeah.
It is calculated on per unit basis, not on total basis.
Yeah.
Okay. So this was our mistake. We were just calculating it on the total basis.
Yeah.
Okay. Then return per factory hour is 85 minus 42.5.
Okay.
Okay. What was 42.5?
Material
Material.
purchase.
Okay. Just we divided per unit and 1.5 hours we divided it. We got a ratio return per factory hour is 28.33.
Okay.
Okay. Then cost per factory hour is 8,000 divided by 10 by 40. Total. Okay. I got this point that it is dividing cost per factory hour. It is on total hours. 10 by 40.
Total hour.
What you were saying. Okay.
What does mean?
You were saying that we have to divide it by total factory hours. So here it is
Total factory hour.
okay. 10 by 40, then 400. Then cost per factory hour means $20. The TPA ratio is 1.41. It means the ratio is above 1.
Yeah.
Okay. So by this question, we understand that we have to calculate it on per unit basis. Return per factory hour will be calculated on per unit basis, and cost per factory hour will be calculated on total basis.
Total basis. Okay.
Okay, clear?
Return per factor hour calculate per unit, per unit, and the total factor hour calculated by the total.
Yes.
Cost per factor hour.
It is clear now?
Yeah, clear.
Okay. Okay, throughput accounting ratio. There's an additional example. A business manufactures a single product that it sells for $10 per unit. The material cost for each unit of product sold is $3. The operating expenses are 50,000 each month. Labor hours are limited to 20,000 hours each month. Each unit of product takes 2 hours to assemble.
10 minus 3 divided by 2.
10 minus 3 divided by 2. You're looking at the answer or you're just telling from the question?
For my mind.
Okay, good. Then it's good. Okay. Then you have 3.5. Your answer is 3.5. Then you have to calculate the cost per factory hour.
To mean that one.
You have to calculate cost per factory hour means total cost
Total
divided
operation expenses for the 18 months, 50 divided by 20.
Yes.
That's the limit, the total of the limit of bottleneck.
Yes, bottleneck. So it is, we calculate this on total basis. So we got to 2.5.
Yeah.
Okay. Throughput accounting ratio 3.5 divided by 2.5. That is 1.4.
That's the greater. That is the good throughput account to make the profit as the interpretation.
Yes, return is good. Now, what I told you, the relation of the things here, how to increase the throughput accounting ratio. I already told you, if you increase the return per factory hour, your throughput accounting ratio will increase. Yeah. If you decrease the factory cost, your throughput accounting ratio will also increase. Okay.
Okay.
And if I try to tell you something more, that this return per factory hour, this you're looking at the screen.
Yeah.
This return per factory hour is calculated on basis of this.
Yeah.
Okay. If your sales revenue will increase,
throughput to be increased.
Yes, throughput will increase. If your material purchases increases,
throughput to decrease.
Yes, throughput will decrease. Very good. Okay. So you can write these points yourself, that how you can increase your throughput accounting ratio by using this formula.
Okay. If the sales increase, the throughput ratio to increase. If the operation cost also to increase, throughput to decrease. If the operation cost is increase, the throughput to increase.
Yes. And we try to just remove our bottleneck or use that bottleneck efficiently, your throughput will increase.
Okay.
Okay. Now we are moving forward. you can just go through these questions as well if you want.
Okay.
And if you have an issue, you can just discuss with me.
Okay.
Now, the second thing is throughput accounting in the public sector.
Okay.
Okay. There, in every accounting technique, they have also discussed the implications and part in the public sector as well.
Okay.
Okay. When we talk about the not-for-profit organizations, okay, there is an example for this as well. So you can just read it out. This is there will be no issue in this. Okay.
Okay.
Now, can we move towards target costing?
Okay.
Okay. Just let me open it once. Try this. Give me 1 second, okay? Give me 1 second. Hello? Hello, can you hear me? Hello, can you hear me? I can hear you. Why you cannot hear me? Hello? Hello? Hello, are you there? Hello?
Yes.
You are there?
Yeah, I'm there.
1 second, I have to actually my ears are paining because of this headphone. I'm just trying to open my speaker. Give me 1 second. Hello?
Yes, I hear you.
I'm just checking one. Hello? Please speak up.
Hello. Yes. Yes.
I'm just trying to switch to the speaker of the laptop, but it is not switching. I don't know why. CIMA system. Hello?
Yes. Yes, I'm hearing you.
You are hearing me, but I just what I want, I'm not achieving that. Okay, I will do it later. Okay, now target costing. Okay. Target costing will be just reading about that. First of all, we are driving a target cost, closing the target
Okay.
cost gap. Third column is empty. Then implications, target costing in service industry. Okay. First, the introduction is there. In modern environment with shortening product life cycles, organizations have to continuously redesign the products. It is essential that they try to achieve a target cost during the product's development. Okay. cost plus pricing. Under traditional approach to pricing, business calculate the cost of manufacturing and selling a product, then add markup to give the profit element. These methods are called cost plus pricing. A major criticism on cost plus pricing technique is that they do not consider any external factors. Okay, demand, competitors, no. Therefore, they are therefore unlikely to maximize the profit that a business will generate. Now, target cost. Target cost, a product life cycle have become much shorter. The planning, development, and design stage of product is critical to an organization cost management process. Cost reduction must be considered at the stage of product life cycle rather than during the production process. Okay. Target costing involves setting a selling price to your product by reference to the market. From this, your desired profit margin is ejected, leaving you with a target cost. First, you take the competitor's product and we see at how much price it is selling. Okay. Then we minus our profit from that and we get a target cost, that at this cost I have to make my product. Okay. Next page. Traditionally, what we do, we have a markup. First, we calculate our cost. Then second, markup. Then third step is the setting the selling price. Okay. In traditionally, when we talk about selling target costing, we first set a selling price. Then we minus the markup. Then we get a target cost. I think it is clear.
Not clear. Can I repeat again? I didn't get that one.
Okay. In traditional methods, when we talk about old times, we first calculate our cost, that how much is our cost of that product.
Okay.
Then we add our profit and we get a selling price.
Yeah.
When we talk about target costing, we go reverse. We first set a selling price, then minus the profit, then we get target cost. Okay. Then implementing the target costing. Define product specification and eliminate anticipated sales volume. First, we have to define the product specification and estimate that how much units we will be making. Then set a target selling price at the company which will be able to achieve the desired market share. You said you will research that what selling price you are setting it. Then required profit is estimated based on profit margins or return on investment. We calculate what profit you want. Okay. Then from target selling price, we minus the profit, we get target cost. We already discussed this. Okay. Estimated cost of the product is calculated based on the product specification current cost levels. We just estimate the cost of the product. What could be our cost? Okay. Then we compare this estimated cost to our target cost, which we set, which we just look at in this formula above. Okay. So we identify a cost gap, what we are estimating and what is our target. We have a gap there, which is called cost gap. Then efforts are made to close this cost gap. Okay, how to reduce this cost gap? If the material cost is high, we can just try to achieve a cheaper source of material from Sudan, for example.
What?
Now, what we have identified the cost gap. So we have to close this cost gap. We have to just reduce this cost gap. So how to reduce this cost gap? We will just search for a cheaper material from somewhere. It could be from Sudan or whatever.
Oh, yeah, okay.
Okay. Next page. Then there are questions. Okay.
Okay.
Any questions in this? Any question in this you have? You want to ask?
No.
Okay. What are the implications? Target costing turns the traditional cost plus approach to pricing on its head, meaning pricing is the first consideration. Traditional, it is opposite of traditional costing, target costing. Cost control is considered right up front as part of the development of the product. If you look at this method, we are directly working to reduce cost at the start of the product, making the product.
Yeah.
Okay. Performance management will therefore focus on ensuring sales targets are met and ways of improving process development to drive down cost. We will try to reduce this cost by introducing new product methods or improving the design, whatever we can. Okay.
Okay.
When we talk about, now we talk about implication of target score in service industries. Target costing approach is a sensible basis for estimating driving down cost regardless of the type of the business. However, due to the nature of the service industry, this process is more difficult in these business. Okay. I was just making my institute PNL. Okay. My, what do you call this, Accountary PNL. So I was not able to, I booked the revenue, what I took fees from you, for example. And now what cost I will minus from it, I don't know, because I cannot estimate my cost.
Yeah, difficult.
It is difficult. In service industry, target costing application is more difficult. Unlike manufacturing, service industry has the following characteristics which makes cost and performance measurement more difficult. First, simultaneity, created at time consumed. It means that when the service is produced, it is consumed at the same time. Okay, so you cannot measure or store this service. Okay.
Okay.
Second thing is heterogeneity. It means if I'm not in good mood, so I may teach you not well someday, and someday if I'm in good mood, I will teach you well.
I cannot stop the time because that more than 40.
Okay.
And to come again.
Okay.